I'm delighted to be here to take you through our results for the 53 weeks ending 21st of April 2024. My name is Nick Collins. I'm the Chief Executive. I'm joined with Stephen Marshall, who's our new CFO. I'll just flick to the first slide and just take you through some highlights and then hand over to Stephen, who's going to go through the financial performance in more depth. I think in summary, we're delighted with our progress. These results set out another year of record growth in our performance. And I think that strong financial performance is consistent with our track record since we IPO'd the business 5 years ago. We've seen record revenue up 24.7% to 353 million. Our EBITDA, adjusted EBITDA on an IAS 17 basis, has gone up 29.3% to 44 million. And really crucially, our EBITDA margins increased from 12.1% to 12.5%. So something we set out 12 months ago, we talked about wanting to get back to pre-COVID levels of conversion, and we're well on that path. Alongside a really strong performance in the mature state of sites, we continue to deliver on our rollout. We've opened a record of 36 new sites during this financial year, and those new sites continue to perform really strongly. And current trade remains excellent. We've seen like-for-like sales growth consistency maintained during FY24, achieving like-for-like sales of plus 7.5%. And over the first 11 weeks of this year, we've seen our like-for-likes at 5%. Over to you, Stephen.
Thanks very much, Nick. So I'm just coming up to 3 months in the business now, and it really is, it's been an excellent induction to the business to see the great operating business that we've got and the great ability to lay down new sites. So I think these slides I'm going to take you through now will really bear testament to that expertise. So the first slide here shows FY24 versus FY23, the overall P&L. As Andy said at the start, we had a 53-week year. That's just an anomaly with us aligning our accounting reference period and accounting year end. Won't happen again until FY30, so a mere anomaly, but it was immaterial to our results at only 2% of EBITDA. So as Nick said, we grew revenue 24.7% to 353 million. And that's a combination of the new sites that we laid down this year, the 36 new sites, and the full year effect of the 29 sites that we launched during the course of last year. So that accounted for 16% of revenue increase, and the balance was that really strong LFL in our mature estate. Gross profit was 27.4%, so higher than revenue growth, and that was because we managed to grow overall gross profit by 90 basis points, which was offsetting the 20 basis points of labour increase with 110 basis points of margin increase. We had strong IFRS 16 adjusted EBITDA growth of 25.9. So just for your reference, this is the version of EBITDA that excludes rent. So that was up 20 basis points. And then we had IAS 17 EBITDA growth. So that's the version of EBITDA that deducts rent from our trading performance. That was up a very strong 29%, and that was benefiting from the improvement of drop through from an improving rent to revenue ratio. So overall, that gave us PBT growth of 56%, a really excellent performance. So quickly going on to the LFL sales performance, as Nick said, we had a really strong 7.5% LFL performance in FY24, and you can see from those numbers there, top right, that it was really consistent. So the first 24 weeks at 7.7 and the full year at 7.5. So really good consistency there. And in our last 11 weeks, +5. But worth noting that those numbers are affected by two things, both adverse impacts. One is that we traded against an extra bank holiday in the prior year. And the second one is that we don't have screens in our sites. So we are negatively impacted by Euro 24. Although, of course, we hope England win, as an aside. So going on to our LFL by cohort. So this is basically plotting the LFL growth by year of launch. So right from pre-FY13 until the most recent mature sites, which was FY22. And you can see a really great consistency across the piece there, showing that even in sites that are pre-FY15, so there are 55 of those sites, they're still delivering really strong year-on-year growth. So this is a real strength of the business. Going on to the next slide then, this slide here shows our margin movement, so our EBITDA margin percentage, our movement from 12.1% in FY23, which is the blue column, and the transitional moves to get us to our exit point for FY24, which is the far right-hand orange column. So in the improvement of 40 basis points, 90 basis points of that was the cost of goods less the labour, which I've already referred to a couple of times. And then also positive was the 30 basis points of site fixed costs. So site fixed costs being rent, rates, and service charge. And as I said, we had an improving ratio, 4.6 to 4.3. So that was an additional benefit. And then on the downside, we had energy costs, negative 30 basis points. We came off our hedge. We were on very favourable rates as a result of that hedge post-COVID, and we're exiting those now. But we're now fully hedged to September, so we have got some line of sight into our 2025 energy costs. Then we were negative 30 basis points on central costs, but worth noting that that is predominantly around increased bonus payments. And finally, we were negative 20 basis points on maintenance costs. But that's not significant in the scheme of things. If you look at the combined revenue and capex maintenance costs, which we'll come on to later, they are around about the 3 to 3.2 percentage of sales mark, and that's the level that they tend to range in. So there's no issue there, and that therefore brings us to the 12.5. And just as a note on phasing, we had H2 phasing of 13.2%, so bigger than the H1 phasing of 11.6%, and that's because we have Christmas, which benefits the Cosy menu, and because we were able to take a price rise in October without an accompanying price rise in national living wage, which obviously happens every April. If I now go on to the margin outlook, this just gives you a flavour of what we're seeing in food, drink, and national living wage, and the table on the right shows our expectations. So we've seen moderating inflation. Average inflation April to April has been less than 1%, so that's a really strong reduction from where we were. And we've seen some marginal inflation over the first quarter of FY25, but we expect a continuation of low single digits with a few specific product exceptions. And that's in line from a trend perspective with what CGA, our industry research consultancy, the sort of authority, is recording. It's reporting deflation for the first time in May, and inflation year to year in May of about 5%. We've done better than that. We've probably a couple of percentage points below that, which has really helped our margins. And then on the drink side, we're seeing inflation April to April of about 3.3% on our top 20 products, and we expect a similar, maybe a slightly less rate during the course of FY25. And finally, national living wage. We know that's obviously kicked in at 9.8% increase to £11.44, and we believe that we'll mitigate that to around about 6.5% in the current year as we manage the pay increases across our labour structure. So bringing you on now to the same version of the margin bridge that I showed you from FY23 to FY24, but this time looking at our medium-term outlook for how we might get back towards our pre-COVID level of 13.5. So this is an indication of the sorts of areas where we see indicative directional moves. And the first positive move we see is in the net of food and drink margin and site labour. So on the positive, we've had a new contract within our food supply in the first half of FY24, which is annualizing and which we continue to deliver benefits from. And we see other opportunities in supply chain optimization going forward over the next 2 to 3 years. So that will help contribute to improving margins. And that will hopefully offset any adverse impact that we see on site labour. Now, clearly, it's an unknown quantity at the moment as to what happens with national living wage, but we're confident that we can do as we've done before and mitigate that as well as anyone can do in the industry. Coming on to site variables, the inflationary outlook is improving, and we implement specific projects on specific cost lines where we see an opportunity, and we'll do that again this year. So there's medium term, there's a good tailwind for us there. And in central costs, we envisage central costs as we grow our top line growing less quickly and therefore giving us a positive impact on EBITDA margin there. So those are the positive factors. On the negative factor, we think commodity prices are low. We think there will still be a small negative impact of us seeing those rise over the coming 2 to 3 years, albeit that we'll try and mitigate those with usage efficiencies. And that just leaves one other factor, which is the site fixed costs, rent rates, service charge. Directionally, we've left this neutral. Directionally, we would hope to grow sales by a stronger growth rate than our fixed costs, and therefore that would allow us to improve the EBITDA percentage. But at the moment, we're leaving that neutral. So that's just indicating really our direction of travel. We're not indicating specific timeframes there. That is our direction of travel and the sorts of factors we see within that approach. So coming on to our IAS cash flow, this shows our very strong cash flow generation in the year. So we delivered 47.1 million of cash from operations, which you can see in that first bold column, about a third of the way down. And that represents 107% of adjusted EBITDA because we get a positive working capital benefit opening new sites. That resulting 47.1 million of cash flow then funds our non-new site capex, so things like our kitchen reset, our splash and dash, our central capex, which leaves us with the 35.4 that you can see in the middle bolded row. And then that 35.4 largely funds 38.7 million of capex that we spent on our new sites. And it's also allowed us to pay back some of our term loan, which was just a restructuring of our overall debt facility, leaving us with cash of 10 million at the end of the year. I talked then about the overall capex of 38.5 million. This schedule here shows the composition of that capex. So new sites was 35.7 million, which is the expenditure on our 33 lounges, our 1 cozy club, our 2 bright sides. In addition to that, you've got maintenance capex of 5.1 million. And as I said earlier on, the combination of maintenance capex and maintenance revenue is broadly at the 3 to 3.2% level. So a really relatively steady level of spend there, but essential for maintaining the sites that are at a sensible level of condition. We've got the kitchen works that we completed this year. We've got splash and dash and external areas. There are elements of smaller elements of refurbishment there that are averaged 130k on our 14 sites. And then that final point on that slide, it really is true that we maintain our sites in good condition, so we stop those peaks of big kind of capex that some other operators have when they refurb, on a grand scale after a certain frequency. But that's not the case for us. Okay, so just looking at the lounge rollout for FY24. So this takes those 33 lounge sites I said that we rolled out in the year. So we launched 33 this year compared to 24 last year. And just running through broadly through the terms of those new sites, we saw a slight improvement in landlord incentive terms from 24 to 26 months. We saw a lease term that's broadly in line with what we've seen before at about 15 years. We've seen higher revenues, but only marginally higher rents, which means that our rent to revenue ratio has improved. It's now 4.7% on those sites, whereas last year in our FY23 sites it was 4.9. Our net capex is 905, but if you exclude Castero, which is in Paynton, and Ormo, which is in Llandudno, that evens out at 875, which is about 40,000 more than the average site in FY23. Why that increase? Well, broadly, it's a couple of things. We have put more covers on average into those sites. You can see there 144 covers. And also, they've been slightly more complex sites. So we've done a slightly higher proportion of heritage or more complex or larger sites, which has driven that But that said, we have driven higher FY24 year one average weekly sales than we did in FY23, so 9% higher at over 33k, and much, much higher than we did in FY19 when we launched our sites, and we were only trading then at 23k. And the result of all that work is that we end up generating CROCI above 30%. So CROCI, just to remind you, being cash returned on cumulative cash invested. Just very quickly taking you through the maturity profile of a new lounge. So what this table on the right shows you is for the FY20 cohort, and we've taken this as a good example. The 16 sites that we launched then, they launched in FY20 for part year, and how did they fare over the ensuing 3 years? And we're showing you gross average sales, EBITDA, percentage in cash, and CROCI. So what you see on sales is a honeymoon period for the first 6 to 12 weeks, where you get a slightly higher run rate as people come and test and see what they think of you. You then see a slightly lower average sales in the next year as your sales stabilize, and then you see really strong double-digit growth, 10-11% over the following 2 years. So hence, we had a year one sales of 26k, a year 3 plus sales of over 31k, so really good growth. The EBITDA develops in much the same way. We have a lower EBITDA percentage in the first year. You can see there 15.3%. And then that steadily increases, and we aim to get above the 20 mark, and that's what you see here in FY24. Just an anomaly there in FY22. You can see an 18.4% there. That was an abnormally high number because we got business rates relief. Average EBITDA growing from 200k in the first full year post the launch to almost 300k at the end. So really strong overall growth there. And as a result of that, strong CROCI growth. You know, our target by the time we get to the end of year 3 is to have 30%, and we've done it very successfully on that cohort. So just taking you to finally to our property debt position. So this is the final sort of cash and net debt. We end the year with 9.7 million of net debt, and that's 3.6 million higher than last year. But obviously we funded out of that our 47.7 million of new site and maintenance capex, and we've also reduced our term loan to 20 million. But in aggregate there, we've got really good liquidity, we've got strong available cash, we've got no change in our covenants as a result of that pay down of the term loan. We've got a facility that's ample for our needs and taking us through to June 2026. So we're really confident we leave this year with a really strong balance sheet and a really strong funding position. So that's all I was planning to take you through. I will now hand you back to Nick for the strategy and operations review.
Thank you, Stephen. So first slide, just going to talk through the highlights as we continue to deliver our rollout strategy. As Stephen has shown, decreasing inflationary pressure combined with increasing scale is allowing us to make really good progress towards re-establishing pre-COVID levels of EBITDA conversion. And despite the acceleration in the rollout and that record number of new site openings at 36, it's the constant food, drink, design, innovation that continues to drive the sales growth across the estate. We've invested further in the senior team and the operational structure to deliver the ongoing rollout, and I'll come on and talk about that in a bit more depth. And we have a strong pipeline of new sites. I think if you look at the performance across the mature estate and how well our new site openings are performing, you can understand how our confidence in that target of 665 sites between Cozy Club and Lounge is one that we believe is conservative and one that we believe we have increasing confidence in. And we've seen both a strong trading performance across FY24 and indeed over the first 11 weeks of the current year. Next slide just talks to how we see the high street, the trading environment. It's a question we often get asked. How's the consumer behaving? And we haven't seen any notable change in demand or sales mix patterns over the last 3 years. It's very much the same. Our consumers behaving really confidently, really, really well. And I think if we look at, the estate's quite big now, 260 something sites, right up and down England and Wales, really broad demographics, geographies, affluence, etc. And there's a real consistency to sales across all of those. Our FY24 like-for-likes were plus 7.5%, and that reflects largely flat volumes and around 7 to 8% of price. And that's fairly consistent with the last few years. If we look at how the business is versus the business pre-COVID, we've seen 26.1% like-for-like sales growth over that 4-year period. And around 5% of that is volume and the balance is price. So quite different to the business pre-COVID, where our sales were dominated by volume growth. And as we progress through this year, very much our intention that we will return to more meaningful volume growth. As we invest in our team and we invest in the offer, we expect to see a return on that investment. Value for money, really very much at the heart of what we do. We remain confident that we continue to offer fantastic value for money in all 3 brands and are very competitively placed on the high street. Yes, we've taken a lot of price over the last few years, more than we would have done historically. I think we're confident that we haven't taken as much price as other operators. We touched on that 11-week like-for-like of plus 5% and note that it's 2.5% below where we finished the last year. And I'd really stress, I don't think it's worth reading too much into that number. As Stephen mentioned, we had an extra bank holiday last year. The football's been a slight negative. I suspect the weather's been a slight negative as well. But there's noise every year in terms of sporting events, weather, bank holidays, royal occasions, etc. I would firmly expect it to even out over the course of the year. And worth pointing out, this time last year, we were presenting a 12-week number, I think, of around 5%. And as the year progressed, we went on to deliver a plus 7.5 across the year. So I just think the 11-week period exaggerates the impact of it. What is important is that all 3 brands are in like-for-like growth. In the lounge estate, the like-for-like growth is pretty metronomic and always has been. Cozy Club, it can be more variable, slightly more variation depending on the weather or national events like strikes and train strikes and things. And then in Brightside, clearly it isn't like-for-like growth, but it's very, very early days. And I'll come on and talk about Brightside in a few slides' time. The next slide looks at the sales profile of the lounge business and how it's changed over the last 5 years. And this is a new slide. We haven't looked at this one before. We thought it might be quite interesting for you. So I'll just take each chart in turn and comment. But top left there, you can see our food drink mix and how that food split's increased from 55% to 60%. I think what that reflects is us delivering food quicker. Turning tables quicker really demonstrates how our kitchens have become more efficient. Moving across to the right, to the next slide, you can see the sales mix and how it splits down between brunch, lunch, dinner, and late night. Pretty consistent with how it was 5 years ago. I think what it really highlights to me is the lack of importance of late night. I think everyone knows that the late night and the bar sector are struggling. It's a difficult part. People aren't spending as much money. But it's a very low level of sales in our business and has been for the last 5 years. Then moving across to the right, you can see how our trade splits between the days of the week, and 43% of our sales achieved Monday to Thursday. That's really important, particularly for the lounge business, and understanding how we're able to generate these really consistent levels of sales and returns on capital in relatively small communities across the UK. And if you think we're generating revenue right from 9 o'clock in the morning through to 11 o'clock at night, and we're doing that 7 days a week, as this chart sets out, really helps explain the success and the consistency of our financial performance. Top right, just looking at the food categories, you can see brunch has increased there, not much else to note. We found the chart in the bottom left quite interesting. Shows a slight decrease in the share of vegetarian dishes. I think we thought about this, and it's probably down to about 5 years ago, the meat substitute products, so things like the Beyond Burger, were new and shiny and very popular. I think we've seen those sales of those come off a bit. Then looking at the last 2 charts, bottom right, you can see more on the drinks and how alcohol sales have dipped 5% in share from 60 to 55. And then looking on the right, I think what really helps understand this is the increase in coffee sales and hot drink sales. And I think over the last 5 years, we've really improved in terms of delivering our coffee more efficiently, and that's reflected in that sales mix. Next slide talks through our investment in the lounge operational structure. And in a growing business that's rolling out sites as quickly as that we are, reacting to that and making sure that we've got the right operating structure in place is absolutely critical, both to the continued success in the mature estate and for the delivery of those new sites. And we've seen a significant investment in that lounge ops map, increasing from 5 to 8 regions. And the regions are a really critical level in the business. It's a key level of responsibility and accountability at that regional ops manager, the people who are responsible for the regions. And us creating smaller regions, lower number of sites, allows us to drive continued operational improvement and, importantly, provide capacity for further growth. And a ratio that we talk a lot about in this business is the ratio of sites to operators, so sites to ops managers and ops chefs. That's currently 4.2 sites to every 1 operator, by far the lowest in our sector. And what that does is it allows our ops team to spend more time in the sites, talking to their teams, driving the right behaviors, and indeed, it allows them to open more sites. And if you think this business is opening a lounge predominantly every 10 days, there's a lot of work associated with that. So we need to make sure our ops team have got the capacity to deliver those openings. 75% of our ops team were previously general managers or head chefs. Really proud of our role in providing career opportunity and progression for people who want to progress or want a career in hospitality. And equally, it's really fundamental to our continued success, the fact that our operators have a really in-depth knowledge of our business. We've also invested in each region in providing them with committed regional maintenance resource, community resource, and recruitment resource. And again, what's that doing? It's allowing our operators to focus on customer and the delivery and allowing this additional resource to look at some of the other areas. I think it's worth noting we recognise that the last 6-9 months we've invested quite heavily in that central cost base, as I've just set out. And we expect to benefit from leverage over that central cost base more in the short to medium term, i.e. we expect that cost as a percentage of sales to decrease more significantly in the next few years. We do find that we go through these cycles where investment can be quite lumpy, and investment of that nature can be quite lumpy. A slide on Cozy Club. I think the headline is that Cozy Club's performing really well. We've seen some fresh impetus in the business around how we talk about maximizing covers, and that's allowing us to deliver really strong like-for-likes, especially around some of those flagship occasion days, and that was evidenced by our performance around Christmas. And really pleased with the impact that Lucy, the new brand MD, is having in that business, and she's been with us for almost a year now. And it's an exciting time in the brand, and we're looking to build on that success I just talked about to date and assume a slightly more premium or a more elevated position on the high street. And we're working on some projects around the food and the drinks menu and how we think about providing that hospitality in the units to help achieve that. And what's really encouraging and important is we have the strength and depth within our existing leadership team to undertake that project without causing any distraction to any other areas of the business. And in thinking about the rollout in Cozy Club, there are currently 2 Cozy Clubs in the pipeline, and we anticipate opening around 1 or 2 Cozy Clubs per year on an ongoing basis. Next slide talks through Brightside and the journey so far. And as I mentioned, sales are really encouraging. We're in like-for-like growth in Exeter, which is the first Brightside that we opened, and it's the only one with any meaningful period of trading beyond its first anniversary, but seeing double-digit like-for-like growth, which we're very happy with. And I think we continue also to be very happy with our operational performance. So customer feedback on what we're delivering is very, very strong, and I can vouch for that. I was there last week, and it was excellent. And what we're doing is we've invested significantly in marketing in the run-up to the key summer trading period because we want to bring more people in. So we've invested in more signage on approach roads. You can see one in the image there. We've invested in advertising vans, which are visiting some high footfall areas. And we're doing some quite fun cross-brand marketing to hopefully benefit from Lounge and Cozy Club customers who are in the Southwest, as they're driving back home after their holidays. I think in terms of the future of Brightside and the potential, it's too early to talk about return on capital, rollout, size of the opportunity. From our perspective, it remains in the lab. It's a bit of an experiment, and we've got a really key summer ahead of us. It's more seasonal business. So understanding how we perform this summer, how much extensive like-for-like growth is in the original 3 sites is important. And in addition to that, we're opening a 4th site in the A1 up near Rutland in the autumn. And that's in a new build property. So it'll be interesting for us to see how kind of attitudes are towards that site. It doesn't have any legacy impacts from previous restaurants, which we did have in the existing 3 Brightsides. Also worth noting, it's on a much busier road, less tourism traffic. So again, it'll be interesting to see how sales react to that environment. Next few slides focus a little bit more on the rollout and the property side of the business. And it was indeed a record year of new openings. And on that map in the middle there, you can see the 36 locations where we opened sites in FY24. Importantly, really good geographic spread, both nudging into new areas like the north or the east down in Kent and Essex, but also great infill in areas where we already have a very strong presence. And what I've done here is on this slide, just pull out four sites, which I think demonstrate the kind of the different types of location and the different types of property that we're happy to take within the lounge estate. So top left there, you can see Costero Lounge in Paynton, a site that we opened in December in a former Harvester. Quite rare for us to open in sites that were previously hospitality businesses, but this is one. We love trading by the seaside. Some of our top quartile sites are seaside or waterfront locations. We knew we'd trade very well here, and indeed we have. Average weekly sales of 72,100 is top of the estate. And indeed, a few weeks ago, they achieved our record ever lounge week with sales of 107,000 during the Paynton Air Show. They're not all like that though. And bottom left, you can see Ivo Lounge in St Ives, and that's St Ives, Cambridgeshire, not to be confused with St Ives in Cornwall, where we also have a site. And this is a much more typical town lounge. Average weekly sales of just under 39,000. There'll be a bit of honeymoon in that number, and that number will come down a little bit more. Likewise, in the top right there, you can see Pontio Lounge in Chepstow, just over the road from our head office here in Bristol, not over the road, a few miles away, in South Wales. And we opened here in February. Gross average weekly sales of 36,000. Again, a very, very typical kind of opening for a lounge. That includes some honeymoon. We'll see those sales dip, and then it will follow that profile that Stephen talked through earlier. I think what's interesting, Chepstow's population sub 15,000. It's quite a small town, but it really helps demonstrate how we perform well in these pretty small locations. Then bottom right there, Riparo Lounge in Westwood Cross. So Westwood Cross is a mixed-use kind of retail, leisure, out-of-town scheme in Kent, and we have another site in Ramsgate, so not far away from it actually. And it's a good example of how well we perform in some of these out-of-town schemes. There's probably two dozen coming up to 30 in the overall estate. So it's a minority of the estate, but it's one where we have increasing confidence. I think the right schemes with a really strong retail lineup and a good leisure lineup, we enjoy great success there. This was previously a Debenhams, this one. And then the next 2 slides, just a couple of case studies on specific sites. Again, just to give you a bit more of a sense of this type of sites that we're opening. So this first one looks at Bordeaux Lounge in the city of Carlisle in Cumbria, where we opened in October. And I think when we first visited Carlisle, we knew immediately that we'd perform really well here. And what that did is it gave us confidence, I think, to spend a little bit more on CapEx. You can see the CapEx there for just under 1.1 million and pay a slightly more expensive rent. And, we've been rewarded with the level of sales there. Average weekly sales of 42,800. Top quartile site. It's been a fantastic opening for us. An interesting aside, and I think a real reflection of how the high street is changing. That stepped rent, that average there of 77,000. This unit, and you can see it in the picture there, it used to be a top man rented to the Arcadia Group on a rent of £240,000 per annum. So a real demonstration of how the rental tone on the high street has come down and really playing to our strengths and helping us with that 4.3% rent to revenue ratio. Population in Carlisle is 100,000. And if we click onto the next slide, you can see a more typical lounge, Veraco Lounge, which is in Bromsgrove, which has a population of 30,000. We opened here in Feb of this year. And this was previously a super drug. And if you look at the picture, you can see it doesn't look much like a super drug now. And I think it's a really important aspect of the lounge model and something that we're really proud of. We're going to the high streets up and down the country. We're investing £1 million or £900,000. We're creating 30, 40 jobs. And we're really improving the high streets. You know, we think we're leaving a really positive contribution to the high streets. As I said, this is much more typical. The rent of 40,000 is actually very low. That's a particularly low rent for us, but that net capex of 867,000, that's more typical, as is the average level of weekly sales, 34,900. And again, there'll be some honeymoon there. That will come down. We're already anticipating a great return on capital. And looking at the map on the right-hand side there, the retail leisure landscape that we're operating here in Bromsgrove, very typical to hundreds across the country. You'll see a couple of banks, a Boots, a Costa, a supermarket or two, a JD Wetherspoon's pub. That's our heartland. Those are the high streets where we trade, and there are thousands of those high streets across the UK. Next slide just talks through our pipeline, which is in a really strong place, and the continues to be the case, as hopefully I've just demonstrated, that the property market is very favourable, very tenant friendly. We've actually opened 8 sites this year. We opened one on Wednesday. We're opening another one on Monday as it happens, and a further one on Wednesday next week. So it's a very busy week for us. We've got a further 46 sites in the pipeline, and you can see those on the map on the right-hand side. Again, great geographical spread. And we build our sites ourselves. We're quite unique in that respect, and it gives us really good control over our capex and gives us really good flexibility as well. And our 5 build teams are very comfortable opening sites at around that 35, 36 number of sites a year. Stephen touched on our average capex earlier, average capex of 905,000. And even if you remove the 2 bigger ones and come down to that number of 875,000, it's still my sense that we can achieve further capex efficiencies, and that's a priority of ours for FY25. I don't think we apply the same diligence and the same scrutiny that we do on the food and drink purchasing side of the business, and we think there's a little opportunity for us to become more efficient. And it continues to be the case that we're investing in design and look and feel and in that team to really innovate and raise our game further. And I hope that's been reflected in some of the pictures that you've seen. It's been a really big year on the people side of the business. Guy Yule, our Chief People Officer, he's been in the company around 18 months, and we've really focused on investing in our team. Particularly in the second half of this year, of the year we're reporting on FY24, we kicked off a number of big L&D projects, initiatives to further drive up our retention. We've introduced our bite size program, which is a complete reworking of how we induct new leaders in the sites, or indeed develop existing team members. We've introduced the step-up programs, which make it easier for assistant managers to become general managers and sous chefs to become head chefs. And we've developed our future ops program. As I mentioned earlier, we're really good at bringing ops through the business from general manager or head chef roles. And this just formalizes that and wraps it up in a program. And as I said, it's a really big year for L&D, for the learning and development team. And I'm really excited about the impact that it'll have, and looking forward to sitting here in 12 months' time talking about that impact. Our 10th Lounge Fest, we just had a few weeks ago. Lounge Fest, it's our annual staff party. We close the entire business down for 24 hours, take everyone to a big field in the Cotswolds where we have our staff festival, attended by over 4,000 people this year. Without doubt, our best yet. And also, without doubt, it's the most important people, cultural initiative or investment that we make within Loungers. And it's definitely my favourite day of the year. And staff turnover, both front of house and back of house, have continued to reduce. But there's more that we can achieve. And one of the things we talk about internally is how cost of staff turnover remains one of the biggest efficiency opportunities that we have in the P&L. And it's great that we're carrying out initiatives on energy efficiency or wastage, etc. But this is by far the most significant opportunity. If we can drive down turnover, increase tenure, we deliver food quicker, we're more efficient from a margin point of view, we have lower training costs, lower recruitment costs. The next slide talks how we're building a senior leadership platform for continued growth. Perhaps most importantly, we've introduced Justin Carter into the Group MD role. You can see Justin there on the top left. And this is the Group MD role, and the creation of that, something that we've been talking about for a couple of years. I think we were just waiting for the right time to put it in place, and we've done that now. And what this has seen the individual brands now reporting to Justin rather than me. So Kate on the lounge side, Lucy on the Cozy Club side, and the Bright Side business all report into Justin. And what that allows is it allows more focused leadership and guidance of the brand MDs from Justin, and they'll benefit from his real experience and leadership. And it frees up me to become more strategic as the business grows, and to focus more of my time engaging with Stephen on the finance side, with Tom on the property side, Guy on the people side of the business, and Jono, our commercial director. And it also creates a structure which can easily incorporate additional brands, should that be something that we want to pursue in the future. I mentioned Kate and Lucy, both new brand MDs, and they've landed really, really well. A great cultural fit, importantly, but also bringing experience and challenge. And with Stephen now firmly in place in the CFO seat, he has really clear priorities in terms of how we want to evolve, how the finance function partners with the operating business, and how we evolve our systems. Our systems are fine, but fine's not good enough. We want them to be great, and if we can introduce better systems to allow our teams to focus more on the customer, then it'll clearly be a very good thing. I think we're at pains to point out we've built a really strong leadership team, and we have confidence both in not just delivering the rollout consistently, as we have done for the last 5 years, but also strategically challenging how can we leverage our scale, how can we leverage that senior team and our experience and our passion for hospitality. As you can probably imagine, over the last few days, we've had quite a lot of questions about the new government and in some instances around Labour's New Deal for working people. And they talked in their manifesto about how they wanted to make some changes to the laws around how our teams work and are paid. And amongst those were banning 0 hours contracts and limiting employers' ability to change shifts at short notice. Further removing national minimum wage age bands, and thirdly, delivering a genuine real living wage where the minimum wage reflects the cost of living. Importantly, there's very, very little detail on any of these. And our understanding, and I think about it as a sector more broadly, is that nothing will happen that quickly, certainly not within this financial year that we're in now. But our perspectives on those are, I think, in relation to the 0 hours comments and flexibility and changing shifts, etc. I think we're fully on board with that. It's something that we have been striving for over the last couple of years, and change that we'll continue to strive for. So we're happy with that. In terms of minimum rates of pay increasing and removing age bands, etc., it's an environment that we've got quite used to. Each of the last 2 years, we've seen the national living wage increase by 10% or thereabouts. And in March just gone, we've seen the removal of the under 23 age band. We're fortunate. We're a big business. We're growing in scale. And we're able to mitigate and absorb that inflationary pressure on our wage line. I think we've got a track record of doing that. And so we're kind of relatively confident that whatever happens from the Labour government perspective, that we'll be able to absorb that. I think what we would say is, I think, that behaviour is fueling inflation, because if we see 10% national living wage inflation, then we will increase our prices along with others. I think the other important factor to note is that it makes it really hard for smaller businesses. It's fine for us with our kind of scale and purchasing power, etc., but margins in our industry are tight, and it's very, very hard for the entrepreneurial kind of single site operator. Last slide in the kind of detailed section of the deck looks at the 5 areas around which our good stuff strategy is built. Looking at the left first, and community is absolutely fundamental to the lounge business. It's something that we talk about an awful lot. Each lounge has its own individual name. That lounge belongs to that high street and has to earn its place within that community. We're on track to deliver over 10,000 community events this year. And also this year, really excitingly, we've introduced our community fund, where each site's given £1,000 for them to use to support a local cause that's important to them. And that's really important. This isn't us sitting in HQ kind of saying, spend £1,000 here or there. It's these guys either saying, we want to volunteer some of our time to support charity X, or we want to donate some food and drink to this, or etc., etc. I've talked a lot about the people side. Moving on to customers and us being proud of what we put on the plate. We're now serving an average of 18 vegan and 36 gluten-free dishes, and us having strong vegan and gluten-free menus is a really important part of our offer. In terms of the planet and delivering hospitality sustainably, we've launched waste and energy campaigns over the year to make us more efficient, and we're partnering with external experts there to make sure we're doing as much as we can. And on the supplier side, we're working with our partners to raise standards. We've now got 91% of our food and drink suppliers registered on SEDEX, which is the Supplier Ethical Data Exchange. And what that allows us to do is it allows us to keep an eye on how our suppliers are behaving and whether they're behaving responsibly and ethically. So if I move on to the conclusion, and just in summary, I think we're delighted to have delivered another record year. And we really point to the consistency of our performance, and the consistency both of the underlying performance in the mature estate, and that slide that Stephen showed, showing the consistency of each cohort, but equally point to the consistency of our new openings and how they're increasing the average level of sales and average level of unit EBITDA. And we very much believe there are exciting opportunities ahead for all 3 of our brands. And we'd also point out that we believe we're a better business for having those 3 brands. It allows us to think differently and allows us to have a degree of competitiveness within the business. As I mentioned, we've reshaped and strengthened the senior team, and we're really excited about what the future holds. And in relation to the change in government, I think their stances on the sector is unclear. We really want a government that champions the hospitality sector. We're such a big employer, such a big contributor to taxes, etc. But we would point out that small businesses need protection. And as the government starts to think about business rates and the apprenticeship levy, we'd really urge them to take that into account. That's it from me. I suspect Andy's got some questions for us.
Diving in, a few questions about growth. Firstly, on new sites, as you were saying, you've been able to source them typically from other retail groups or banks. Looking forward over the next 3 to 5 years, where do you see new sites coming from? Any different sources?
No, I think very, very much more of the same. And we've done a few banks quite recently. I mean, there have always been banks in the estate, and we've done a few more recently, and we are seeing a few more of them actually. And banks are great because they typically, they have lovely buildings, lots and lots of period features. They tend to be quite prominent, which is very helpful as well. Albeit they can sometimes income with additional capex costs. But no, we want light, airy, open, wide frontages, prime pitch on high streets, and so I don't see any shift in the kind of strategy over the next 3 or 5 years.
Okay, and in terms of recruiting top quality staff, which you've mentioned as an important part of the cultural side of things, do you think that you'll be able to get enough high quality site managers for all these new sites that you're planning?
Yeah, I think and it's interesting. I think a lot of other operators talk about the difficulty in recruiting people, and finding chefs has never been easy. I think it would be fair to say, but that's been the case for 20 years. That's not a new thing. I think post COVID, immediately after lockdown three, finding people was very challenging, particularly chefs in some parts of the country. But for the last year or two, it's been normal, and we've worked very hard about how we behave as an employer, and make sure that we're reacting to what younger people want from an employer today. But I think that at the end of the day, the proof's in the pudding. We created 1,200 jobs last year. We filled those 1,200 jobs, and we continue to work very hard at it.
Okay, Stephen, one perhaps for you. A number of times, supplier rationalization and the opportunity for savings has been mentioned. Could you give the viewers an idea of how many suppliers you actually have and where they're based? Are they national chains or more regional?
Well, we typically, when I talked earlier on about us consolidating supply, we consolidated to two principal suppliers through whom we get wholesale suppliers and then nominated suppliers. So that's the way it works, and that's the way that we've driven efficiency. And we've got, I think, a really good opportunity to basically drive value out of that approach. I mean, we could go down to fewer suppliers, but I think then you're getting into questions of certainty of supply, and that's we're not ruling that out, but at the same time, what we want to do is say, are we happy that the operational standards, the SLAs, and all those sorts of things are in place, and also do we think that the reward is worth that the reward justifies that movement, and that we're fully underwriting any of the risks. So we don't do that lightly, because at the same time, you've got to imagine that with the LFL growth that we're seeing, we should be able to demand. I say demand. Perhaps we should be able to negotiate. Let's say we should be able to negotiate favourable terms. I mean, if you think on the drink supply side, if you're putting down 30, 35, 36 sites every year, then your volumes are increasing, and that's an environment where things like volume discounts and retros should be part of the core negotiation strategy. So it's about taking a rounded approach to our overall supply base, and we're a very thoughtful business. We don't do things without due consideration, but we think that the general direction of travel is that the growth that we can give to new suppliers gives us a great opportunity to share in some of the benefits that they'll get their end.
Great, and then perhaps a follow on from that, when you are negotiating new supply contracts, is it as simple as it looking at price in relation to food inflation costs?
Well, I mean, I guess we look at a number of things. We look at quality, because obviously we need to maintain the quality of our food offer, and that's 14 great shifts is all about not just service, but it's about quality of food as well. So it is quality, and it is price in combination.
Okay, thank you. And perhaps again for you, Stephen, a lot of talk about successfully mitigating rising wage costs, particularly in the national living wage scenario. Could you just give one reader a little more detail on whether you are actively employing more younger people, typically under 21s?
Mm-hmm. I mean, we don't. I guess it's not a case of us actively actively recruiting younger colleagues. The reality is that we do have a number of younger colleagues, because if you're a student who's wanting to top up their study or to top up their hours and their other work with 8 or 10 hours of hospitality, then we're a great place to work. We constantly talk about the fact that you can theoretically, if you're an 18-year-old, go and work for DPD or Morrison's or Amazon and command a a higher average wage than you get from us now. But actually, the reality is that people like working for us. So yes, we do have we probably have a slightly higher proportion of those younger colleagues than others of our sort, but that really works for us. It works for us in terms of the flexibility of those hours and our ability to manage our work, our labour requirements, and it works from their point of view in having a really fantastic place to work.
Okay, thank you. And staying with staffing, is there a difference in the proportion of wages to sales as a ratio in a new site in its first year versus a more mature site?
Yes. Not much though. So no, when a site opens, typically honeymoons, as Stephen set out in his slide earlier, and there's a period of real high risk there. So we will support that site with experienced people, and then we have this balancing act once the site's been open 6 weeks, and we need to kind of wean it off the support and start to bring it down to what we'd consider a mature level of staffing, but without jeopardizing the kind of the hospitality and the customer experience. So, but yeah, so for the first 6 months on a kind of decreasing rate, it will be marginally more expensive than a mature site.
Right. Question on food innovation. Thank you for a very useful slide looking back over recent years. Can you say a little bit more about current trends and how Loungers is adapting to them? And do you see any competitive threat from new food trends that are emerging in the market?
I mean, the great thing is, I think I said, is that the about all our menus across all three brands is we can sell whatever we want, and so we're not we're not a burger restaurant limited to burgers, and we're not a pizza restaurant limited to pizzas. We can have anything on our menu, and that's one of the wonderful things, and that innovation and evolution of the food and drink side is an important factor in our continued success. And we talk about wanting to stay on the shoulder of trends. And so what's happening in, kind of in Shoreditch and Soho and East London isn't necessarily going to be that relevant to our site in Bangor or Corby or wherever it might be. But then we want to nudge people in the right direction. So that's how we think about food development. So right now we're seeing more Middle Eastern food. We're seeing more Asian food. We're seeing more spice. I think we're seeing more Central American stuff as well. And we had an amazing dish the other day. We're doing some breakfast quesadillas with a bit of chorizo and chili and some fried eggs, which were delicious. And if you think about our sales mix, the lounge breakfast, which is akin to a traditional English breakfast, is the best-selling dish in our business and will always be the best-selling dish in our business. And the way I think about product menu development is there's two ways. One is creating new dishes and nudging people in different directions. The other one is making sure that our best-selling dishes are continuing to get better. And we think about it in both those kind of directions.
Okay, very clear. Again, going back to sites, and you mentioned the much more favourable rental conditions that you can see on the high street now. We have a question. Landlords seem to be very favourable to Loungers. Do you think there's any risk of that changing in the near term as the economy starts to pick up a little bit?
No, not at all. I mean, I think that we've seen over the years that as our covenant strength has increased and the level of competition for sites on the high streets has probably decreased, our positions got better and better. I think there was some concern that as interest rates went up, that the availability of cash contributions. So landlords typically give us packages of cash contribution to help fund our fit out costs alongside rent-free periods. And there was a degree of concern that the level of cash contribution might go down as interest rates went up, because landlords would find it difficult to fund those cash contributions. But that hasn't actually been the case. We have good relationships with landlords. We have many different landlords, and we negotiate hard. And I think one of the key criteria in our success has always been that we've never taken sites. We've negotiated hard on rent, and so even if there's a lot of capital on the table or a massive rent-free period, we will always be driven by the rent and making sure we get the right rent. And that helps demonstrate why that 4.3% rent to revenue ratio really is by far the best in the sector, because of that rental discipline.
Yeah, no, very true. And then just a final question, looking a little bit further down the road, an inquiry about whether the board reviews the possibility for dividends. And clearly you are in a period of rapid growth and investment at the moment. So when do you think that might change and your cash flow free cash flow be in a position to look at distributions?
I think not in the short term. I mean, the board, and you can imagine over the last couple of years and some frustration with the lack of movement in our share price, and the board kind of regularly consider dividend policy or share buybacks, etc. And I think and we'd be guided by our shareholder base ultimately, I think, and what their perspectives on it is. And I don't think we're not hearing any kind of demand for a dividend from the majority of our shareholders. I wouldn't say never, but we are, we're a rollout, we're a growth story, and reinvesting that cash in terms of in that rollout is a really important part of what we do.
Great. Well, just remains for me to thank our audience for their attention and a wide range of interesting questions. You will receive a feedback form, which the company would be delighted if you could just spare a few seconds to fill out. In terms of commentary, as already mentioned, this video will be redistributed, and that and research notes from Caroline Gulliver, the equity development analyst, are available on both the equity development and the Loungers website. Nick's lamenting on the share price has been ameliorated a little bit with good performance this year, and Caroline retains a fair value of 370 pence per share. So we still see scope for much more improvement in that area. On behalf of all the audience, can I thank Nick and Stephen for an excellent presentation and wish you all the best in further successful rollout.
Thank you very much indeed.